Rohr here with an early global view on Friday, September 18th, 2015. It's currently 6:45 a.m. U.S. Central Time, and today richly deserves a global view because so much shifted after the FOMC decided to hold steady at 0 to 25 basis points for the base rate in the U.S. yesterday. And this is more important than just them holding steady. Could this be the beginning of the admission that all the massive QE has not really worked to revive robust economic growth? That has implications for other economies as well. We'll get into that also in a commentary over the weekend. And what did all this mean to the markets? This was really pretty incredible. The Fed not hiking initially, as you can see, because this is the 1 p.m. reading on the S&P 500. This is the half-hour chart, so it shows that incremental response right after the statement at 1 o'clock was to get nervous about it. Janet Yellen then, talking about things remaining accommodative, seemed to bring in the knee-jerk buying that's so typical, which ran this up to 2010. December contract just short of the 2015 resistance we had noted was the bigger weekly down break. But remember that September was still on the board yesterday until the close. It expired at the regular trading hours close of business, and it ran up to 2020. And we'll see that on the weekly chart when we look at the intermediate term picture. But then what happened is, as the extended discussion evolved into the projection showing that the Fed was not even going to hit, much less exceed, its 2% inflation target until 2018, it started to leave the sense with the equities of just how weak the Fed was now seeing the global economy and how that was backlashing into the U.S., and it ended up sliding all the way down to finish at 1977. Now, as if that weren't bad enough, this morning, the December S&P is off 18 at 1959 as we speak. In other words, it's right down against the trendline support since the big lows on the disastrous early trading off the Chinese currency move 3 weeks ago Monday. So here we are right into this trendline support. Now we have to allow the bigger lower support. It's not just congestion on the December contract, but it's the bottom of the gap from that lower opening and ranging down 3 weeks ago Monday, that it was 1970 close in the lead contract, actually 1971.40, but testing 1970 from the previous Friday. So on the weekly opening, it gapped down, and on the bounce back on that Monday, left a high of 1950. So 1950 is quite a big level now, and if it were to start to slip below that, you're looking at least for the trading on the contract at 1930. The bigger interim level historically has been 1920, but with the really big levels down around the 1900 area with a tolerance to 1895. So that's what we're going to be looking at. And again, we would be focused for now on whether this goes from bad to worse today. And what's going to be interesting, if it does open that bad, on the indicators, the hourly MACD that has been out ever since the market pushed above 1950 back on Tuesday, the hourly MACD that's been out above its upper runaway band would be sinking back below it, and that often is a sign the market will be done with the rally for now, pending further insights on just how bad it can break or whether it holds lower support and goes quiet. And that pretty much does it for the short-term view of the S&P 500.